Hey guys, it's Dave from MortgageGuy.com. And in this video, I'm gonna go over unimproved versus improved real estate taxes and everything you need to know about this topic. But before I do, please subscribe to my YouTube channel to keep up with more videos like this. Let's talk about the definition of unimproved versus improved. Unimproved real estate taxes are going to be based on usually a situation where you're buying a new construction home and the taxes are only based on the land because that's what the county appraised it for previously because there wasn't a house. And then improved is going to be based on the land and the home. So a couple things to keep in mind going into this when you're buying a new construction home is the builder is going to give you a credit for the amount of taxes for the period of the year that they own the home or own the property. But if it was based on unimproved, so let's say the year prior is just based on the land, they're going to give you the money at closing based on only that. But for your mortgage, it's usually going to be based on a payment that includes the improved taxes. What they assume, the lender, what your mortgage payment's going to be with that tax amount. Now, how do you figure out what the improved tax is going to be? The general rule of thumb is this. They're going to take the sales price times the tax rate times 90% and then divide that by 12. And that's going to be the tax amount that you see in your payment. Now, you've got a couple options when you go to closing. If the builder is only giving you the improved amount, builder is giving you the amount for unimproved. And when you go to closing, they're going to collect in your escrow account by the lender on improved, there's going to be a difference of the amount of money at closing, right? So if there's, let's say you're closing in March, they're going to do 3 months of unimproved, a very small amount, because remember, it's only based on the land. Your mortgage payment is going to collect improved for those 3 months plus the buffer of, let's say, 2 months at closing. Well, if the unimproved amount is $50 a month and the improved is $500 a month, that's $450 difference times those months at closing. So it can throw off your bottom line, meaning you would need more money at closing than maybe you were prepared for or what appeared on your mortgage estimate. Depending on the time of the year and when you close, you could do unimproved for your escrow account, meaning that the builder is going to give you that unimproved amount and then in your escrow account is going to be the unimproved amount. Now, here's where you can run into problems. When your tax bill comes out, so let's say it's at the end of the year, if the taxes are based on the unimproved, then you probably have enough money in your escrow account to pay that tax bill. If it's not, and it's based on the improved, so that higher number, you may need thousands and thousands of dollars when that tax bill comes out that you don't have in your escrow account. This is what leads to what's called an escrow shortage, which you hear a lot of people who bought new construction and their numbers weren't done correctly or they weren't prepared. They end up, when that tax bill comes out, that dollar amount being way off. And then you have options with an escrow shortage. You could pay the difference and your payment's going to go up to make sure it can cover the taxes for next year. So 2 big surprises. If you don't pay the shortage, the payment's going to go up and it's going to go up even higher than what the payment should be to collect the extra money needed for your escrow account shortage. And so sometimes you'll see builders, lenders lowball some of the tax numbers, maybe to make it look good on paper, and then you end up having that surprise. My advice in this situation is prepare yourself to be spending some extra money up front to set it up as an improved taxes in your mortgage payment. So when that tax bill comes out years down or at the end of the year, you're prepared for it. There aren't any surprises. It may be a little bit of a surprise setting it up at closing and bringing in a little bit extra more money, way better than getting hit with that later on and not being prepared. And it's also preparing you for what that payment is going to be. So, unimproved versus improved taxes, everything you need to know, I just broke down for you. If you find this video helpful, I'd love to be your lender. Subscribe to my YouTube channel and stick around for this next video. I think you're going to like it. Thanks, guys.